Welcome to Opal's TV. Today I'm in New York with Nigol. He's the founder of Quest Partners. Quest Partners is a very interesting company because they have been running a strategy for over 2 decades now. They are negatively correlated to markets and they have achieved since inception a double-digit return. At the same time, we know that this has been really a challenging environment, particularly the last decade, for hedging strategies. And I'm here now to talk with Nigol about his secret sauce. So tell us, Nigol, how have you been doing that?
The last 2 decades have been particularly difficult for hedging strategies, and our goal is to be able to provide hedging while providing returns, on a carry basis, rather than the typical strategies that are basically bleeding and then just making money once in a while. So the way we've been able to do that is by effectively looking at volatility in a more complex way than most market participants. Effectively, if you look at the real risk in the market today, the risk is not in the volatility. Right? The risk is in the vol of vol. Effectively, the vol is very low when the market is going up and then increases very dramatically on the way down. So what investors are actually getting paid for is the instability in the volatility rather than the vol. So they're getting paid a lot for what seems to be a very low volatility, but in reality, they're getting paid for the risk of the vol increasing on them. So you see 8% vol on the S&P when it's going up, and then 40-50% vol when the S&P is going down. So the instability in volatility, similarly the instability in correlation, is what actually investors are getting paid for. We call it convexity, or the fact that risk metrics are not stable over returns.
So Nigol, tell us, what do investors actually miss by not fully understanding Skew?
The risk that investors are taking in terms of peak to trough losses is actually predicted by Skew. So the change in volatility. So as investors are making money on the way up in markets, they're actually enamored by high Sharpe ratios. They're allocating to strategies that are easy to allocate to, easy to explain. And those are typically the high Sharpe ratio strategies. Unfortunately, those are the ones that are most prone to surprises when the market starts to go down. And therefore, these are the strategies where the returns turn negative when the market starts to go down substantially with the tail event. These are the strategies where the vol is expanding when you're losing money. These are the strategies where the correlation to the S&P is increasing when the S&P is going down as well. All these shifts in market beta, vol, or correlation are predictable based on Skew. And today, we're in a market environment where the Skew of the S&P is the most negative ever.
So if we just step back and look at the markets broadly, isn't it that a lot of the market dynamics is actually driven by behavioral biases from investors, don't you think?
So investors chasing high Sharpe ratios actually reinforces bubbles in the market and actually has the impact of encouraging short convexity, or effectively buying the dips in the market and selling the rallies, option selling. So you have these pensions that are selling hundreds of billions of option premium, which is effectively a commitment to buy the dips and sell the rallies. This has the impact of actually pinning price. Effectively, the price action is not correlated to economic factors volatility. It's actually more driven by the liquidity that the Fed is providing and then the optionality that other market participants are selling. So this has the effect of creating these perception of stability, and then the instability is again very, very strong when the surprise comes. Our strategy in particular is here trying to find places in the market where this is happening the most intensely, whether in which sector, with which markets within a sector, which time frame it's happening the most in, and also which momentum or mean reversion strategy is the most affected by it. Therefore, looking for places where we can be long convexity, be long momentum with a large amount of alpha, and most importantly for this alpha to be positively skewed on top, to have long insurance characteristics. So the choice that we have of exposing ourselves to momentum within these four dimensions, which market within a sector, which sector between the different asset classes, which time frame, and then finally which type of momentum strategy, those choices are made through crowding filters effectively. We're trying to see where have investors piled on in the most, which time frame, which market, which sector, which momentum strategy, and we're trying to be long convexity in these different aspects which are the least crowded effectively. And in order to do that, we're actually trading quite short term. So we're trading about 8 days per trade on average. So we're quite active from a trading perspective. Trading short terms allows us to have the most convexity per unit of risk. If we traded more long term, we would become more and more negatively skewed, similar to longer term momentum strategies. If we traded more short term than that, then we would become too transaction cost sensitive. Trading at about 8 days per trade on average allows us to have as much convexity as we want, to have the momentum beta, which I think is valuable in a portfolio, but also most importantly, to have this alpha, which is very, very long convexity, which is used to fill the gaps in a typical hedge fund portfolio. So when you see that the hedge fund portfolio is getting surprised, the returns are turning negative, the correlation is increasing, the vol is increasing, those gaps in returns are the ones where we're trying to make the most money, and that alpha is coming from that short-term trading. In order to do that, we're basically choosing to have about $2 of momentum alpha per dollar of momentum beta. There's a part of our industry which is replicable, which is pure momentum, which is replicable by moving averages. For every return that comes through that beta, we want to generate $2 of alpha relative to that index, let's say. And that time frame is also how we tune that ratio. The more short-term we go, the more alpha we will generate and the less beta to the index. And the more long-term we go, we would start generating more beta and less alpha. So that time frame is actually very, very important in deciding the characteristics of our program.
So market corrections have become shorter and also sharper. And a lot of hedge funds have struggled with that, particularly, of course, the so-called mega funds. So tell us, Nigol, in detail, what are you doing different here?
Trading short term is very costly. What we do differently is that based on our filtering techniques, we're able to decide when to trade short term and when to trade more long term, right? By the inefficiencies within these four dimensions that I mentioned. And where the typical large mega fund has had to slow down their trading, they've had to become more long term, more long biased, more long equity exposure, more long fixed income exposure to basically improve their Sharpe ratios. We've gone in the opposite direction. We've become more short-term and more reactive. And the way we've been able to do that is by all these filtering techniques around volatility and convexity that we are using. So we've become more dynamic, and as the market corrections have become sharper and faster, we've been able to react very fast while keeping costs under control. And the choice to trade slow or fast requires a very deep understanding of Skew. So the key thing is which trades to take and which ones to avoid. And this filtering is really the key ingredient that we do differently than the rest of our industry. And there are three main filter families that we utilize. First is different types of vol compression. So where typical asset manager uses standard deviation of returns as a measure of risk, we have about 30 different vol measures that measure vol specificities, and we look at for vol compressions in those different aspects of vol that are typically not visible. Second is convexity. Sometimes the vol on the upside is very different than the vol on the downside, or like Skew. So, and for most investors where they see a vol of 15%, it could be vol on the upside is 8%, vol on the downside is 40%. That's another inefficiency that typically creates this surprise moves for investors. Finally, the third filtering mechanism that we use is crowding. How convinced are other asset managers of a certain strategy or of a certain sector, of a certain market, of a certain time frame? The more convinced they become, the more these large platforms are allocating to these strategies, and the more we're actually trading against them. So these filtering techniques give the quality of our returns, and they're the ones who allows us to generate this strong alpha. Crowding is extremely important today because the quant world has expanded tremendously. You have thousands of quants coming into the market every year, all using very similar optimization techniques. So if you give these quants all the data they want and all the computing power that they want, you will see that they will all have great simulations with great Sharpe ratios. Unfortunately, once they go into the market, most of these quants will not be able to generate returns. And this is not because they have actually over-optimized mathematically for their models. It's more a question that those optimizations are resulting in an asset flow into certain strategies, and the market doesn't have the capacity to handle these strategies and is immediately changing. So the market is actually doesn't have as much capacity as most investors think. So it's very quick to rotate between which factors are going to work or are going to become effectively crowded. What we're trying to do is effectively guess the next market regime based on what the consensus view is right now on what is working, right? And to do that, it's not only a question of doing the quant work and being able to look at all the factors that people are looking at and all the different types of optimizations people are doing, but we have to have a very, very objective view of our own thoughts, a very objective view of our own convictions. And this is where, for me, I've been meditating for 25 years. It's been a very, very effective tool on allowing me to see my thoughts as something which is outside of me, not something I necessarily identify with. And I'm very comfortable looking at many different types of thoughts and saying, I like this one, or this one is useful right now, this one is not, and maintaining these like parallel ways of thinking. And this allows me to understand the market from a broader perspective than being attached to one way of thinking. This discipline that results from a risk perspective is also very, very important, right? So the discipline of doing what I know has worked in the long term as opposed to chasing the short-term returns like most quants do. And that discipline comes with a very long-term perspective. It comes with an understanding of risk, and that risk is implemented completely mechanically rather than discretionarily. So a lot of times the best positions that we have are the ones that we have. There seems to be no reason for why we have those positions on. There's no fundamental news that justifies the position. That's the position that seems to work the most, as opposed to when we enter positions that are, oh yeah, we understand, we're entering this, we're long crude because of this and that, and by the time we enter, that seems to be a so-so position. So the way we exit positions is really critical. Because of these filtering techniques where we're entering the market after volatility compressions, we're able to enter very strong, very dynamically and quite fast markets at the inflection point where something has begun to happen. The typical insurance is to buy insurance and pay, basically pay the cost of insurance over time. Our strategy is to basically see where's the vol cheap and then to wait for a breakout, and that minimizes the cost of carry, the cost of being long insurance. That's very, very important. Because of the low vol at the entry point, we can also have very tight stop losses. Okay, so that's critical. Once we are right and the trade is starting to work, our exit is also very different from a typical quant, where the typical quant will exit based on a price reversal. So the trend is going on for days, weeks, months. And then for a quant to exit, it's typically a question of the vol having increased or a trend, but eventually the price has to reverse and to start to reverse before they exit. In our case, for profitable trades, 2/3 of the time we're exiting or based on time. After a certain amount of time, the alpha of the vol expansion is no longer there and we exit the trade, even though from a momentum perspective, the market is still a valid market to be in. We're exiting based on time because the vol expansion is no longer there. And most importantly, we're exiting from a perspective of crowding as well. So depending on which factors along these 4 dimensions of momentum trading are expensive and which ones are cheap, we might exit certain equity indices and enter other ones because the convexity is cheaper now in other markets, or in another asset class, or another time frame, or in another trading strategy. And so those exits, whether they're time-based or crowding-based, are very, very critical in extracting alpha without unnecessary exposure to the negative skew of markets today. So again, what we do on the risk management side is quite different than the typical fund, where the typical fund is building a portfolio which depends on the stability of volatility and the stability of correlation. We're betting on convexity. We're betting on the change in vol and the change in correlation. That's really important. As a result, the way we build the portfolio is actually much less optimized than a typical quant fund. So we try to normalize risk across asset classes, so 25% allocation to commodities, 25% to FX, 25% to equities, and 25% to fixed income. We allow the models to do their allocation and the allocation based on the very micro type risks and factors that are actually playing out in the market. So equal risk allocation as much as possible with a lot of variation, where most quant funds you can trade with strategies that are 100% of the time in the market. We're in the market only 30% of the time with very varied position sizes. The way we measure risk is not based on VAR or standard deviation returns. It's actually using measures of risk that take convexity into account. Okay? And we also can go on for a very long time in certain asset classes without making returns. Because then the longer the returns are not present in an asset class, typically the more convexity you have, the more element of surprise, and the bigger the upside return. So we tend to be, our exposure tends to be normalized across the asset classes. We normalize based on vol. We do not use correlation into account because correlation can flip very easily, again, in the direction of convexity. You can have two assets that are negatively correlated, such as equities and fixed income, but in today's world, both have become negatively skewed, which means when there's a big surprise, both equities will go down and fixed income will go down. The lower the yields on fixed income, the less upside there is, and there's the bigger the risk on the downside. So when the real event comes, you will see both equities and fixed income go down at the same time. That can easily be predicted during using Skew. That type of behavior prediction will not happen when you look at the vol and correlation alone. So effectively, our risk management is extremely robust. It's actually quite different than what most asset managers are using. And we're actually using other asset management's risk budgeting techniques as a way to predict their behavior and their need for liquidity.
So, Nigol, some of your investors are among the world's leading institutional investors and public pension funds. I would imagine that they are really attracted to your differentiated return characteristics. Is that so?
Absolutely, Matthias. So the way we've designed AQO is for it to provide the best incremental risk-adjusted return to the typical pension portfolio. Remember, filling those gaps in liquidity. When the vol is increasing, the correlation in assets is increasing typically. We're trying to provide returns in those environments. As a matter of fact, if you create a portfolio of the S&P plus AQO at the optimal mix, we actually doubled the return of the S&P over the last 22 years. And we also improve the return to drawdown of the S&P by 6 times. We would also improve the return to drawdown of the hedge fund index by about 2.5 times. So the portfolio characteristics of what we do are quite attractive. From the perspective of alphas, our information ratios to different indices, whether the S&P, the CTA index, or risk parity is about 0.6, 0.7. So very, very attractive information ratios. And on a standalone basis, you see that our beta to the S&P is about minus 0.5, with 11% of true alpha, right? Our beta to the CTA index is about 1.2 plus about 6% return plus a free put on the S&P. Effectively, if we gave you this alpha of 6% a year to the CTA index with no returns, it would be extremely valuable because the timing of the alpha, it looks like a put on the S&P. And that put would be worth also about 8% a year in returns to replicate. So the true value add versus a typical momentum strategy is about 14% a year. Overall, the goal of our risk management is to create a portfolio which is very robust and able to handle surprises and shifts in market regimes. So what you see is actually our returns during VIX increases or quarters where the VIX has gone up are actually returns are 5 times higher than returns when the VIX has come down in a quarter. Same thing if FX volatility has gone up, we tend to make 5 times more returns than when FX volatility has come down. In the case of fixed income volatility, when fixed income volatility has gone up, we tend to make about 15 times more returns than when fixed income volatility has come down. So we're very robust in crisis periods and surprise periods. So when you look at it from the S&P perspective, we tend to capture 25% of the returns of the S&P on the way up, and we tend to offset 75% of the returns when the S&P is actually going down.
And Nigol, what is your view on the current market regimes and what opportunities do you see in there for you?
So the way we got here with 2 decades of very strong central bank interventions providing liquidity into the market exactly at the right times to quelch volatility, we see that that's potentially coming to an end due to multiple reasons. First, the skew in the market is the highest ever, and the skew of the market is extremely correlated to the Buffett ratio. As I mentioned, the Buffett ratio is 2 to 1. In the past, it's been around 0.6, 0.7, and the higher that number goes, the more unstable markets become. Effectively, expect the S&P to go up slower and to go down very, very fast in comparison to the way it goes up. That's one uncertainty in the market. Second, interest rates have gone from about 13% in the late 70s all the way down to under 1 or even negative in some cases. The lower interest rates are, the more negatively skewed fixed income becomes and the less ability fixed income has to hedge equity corrections. That has the effect of potentially surprising people because the level of protection in their typical balanced 60-40 portfolio is now no longer going to be there, and that could provide a destabilizing factor as well. Finally, with interest rates being so low, the uncertainty around inflation is extremely meaningful. Most investors today have not seen inflation. And with the amount of money that we're printing, the type of budget deficit that we have, that's a main driver of the economic growth today. That's something that could have, if it reverses, could have very, very negative impact. Because the the inflation uncertainty typically results in higher volatility, and commodities are something that cannot be printed. So central banks and governments can actually intervene in commodity markets and provide some tax advantages to certain industries where they want prices to remain low, but you cannot print commodities, and in effect, once inflation hits, very quickly assets will flow from the financial system into commodities, and that's typically how these big financial bubbles, such as the one that we're in, have typically ended. We're not betting on that. We're betting that if that happens, we're going to be long vol and we're going to benefit from those vol expansions. So these 3 risks to the market regime are very present today. They're stronger than ever. And not only is this the risk on prices, but it's also a risk on what people have learned about the markets. Effectively, quant strategies, buying the dips, risk parity, all the learning through machine learning, through quant, through discretionary macro, all the assumptions that people have about the market might reverse very dramatically once inflation hits. Effectively, central banks will not be able to basically have this mean reverting aspect within markets, and strategies have to be very, very different as well. So all these things combined create an environment where we potentially have things that have been a massive headwind to our strategy to the market becoming a major tailwind. And we look forward to that. Over the years, we've gotten better at what we do. Through all the research and all the improvements we've done, especially with the crowding family of systems. But we look forward also to an environment where potentially things get easier. And it feels like we're getting close to this, to the end of this major cycle with these little pockets of inflation showing up.
Brian Brookman is joining the interview now, and he joined Quest recently as head of research. Brian, tell us more about your background and what you're doing at Quest at the moment.
Thanks, Matthias. I've been active in the macro space since 2007. Prior to Quest, I was at a large asset manager based here in New York. I was one of the founding members of the team, and we grew that to more than $100 billion business at the time I left. Prior to that, I got my PhD in physics, and I think of myself as actually a researcher now who's applying a scientific method to systematic investing. That's what I've brought it to Quest. So what attracted me to Quest, Matthias, is that I really think that there is a differentiated approach to investing here. The team, Nigol in particular, have a track record of more than 20 years delivering very powerful alpha with a positive skew profile, and that's very, very unusual in the industry. Very, very few people have that tenure at delivering that kind of high-quality track record. I think an additional thing for someone like me who has a large background in systematic research is the platform here, both for research and trading, is world-class. The data that exists and the ability to research and systematically execute those signals really has no comparison to other places that I've seen. And that makes it exciting not only for me, but other researchers that would look to come here to implement their ideas and generate compelling sources of alpha. So let me tell you a little bit about what we're working on in research right now. First and foremost, we're always focused on delivering that positive skew profile and deploying both that philosophy that's applied across all the signals that Quest trades and thinking of new automated ways that we can apply that philosophy and idea across a range of different signal types. A second big area is looking for new markets, new things that we can invest in that can deliver meaningful convexity and return. There's a huge number of these new compelling markets in different geographies, different asset classes, exploiting new markets like carbon, et cetera, that have only been created for the past few years, and that we think actually have meaningful potential to add positive skew and meaningful return in the context of AQO. Last, one of the big areas that I came from is looking at macro signals that are not purely price-based. And I think in addition to that, over the past 10 years, we've seen a sea shift in the way capital is managed. People increasingly are using smart betas and other things like that. And that has fundamentally changed the way in which markets behave, and designing signals and systems that exploit that change in investor behavior in order to generate attractive returns is another key element of what we're focusing on for the rest of this year and into next.
Brian, you mentioned smart beta. And we all know that smart beta and risk premia have really risen in prominence and gained momentum and assets. What is your observation here?
I think that's a really good point. And there's no question, if you look back over the past 5 or 10 years, the amount of assets and capital that has been deployed in purely mechanistic and simplistic strategies consistently has increased exponentially. Things like risk parity that exclusively are looking at recent volatility and levering or delevering a portfolio, very similar no matter who's applying it, certainly create a tremendous amount of crowding they've created over the past several years. And I think it's not a coincidence that after you saw those kinds of investing, whether it be smart beta or risk parity, rise to prominence, their subsequent performance has actually been somewhat lackluster. One of the things that we try and do on our side is to understand how capital is being managed using those kinds of very common, very mechanistic, very simplistic approaches, and identify what kind of opportunities that can create in markets and exploit them in the context of our investment signals and strategies.
Now, as we have learned, at Quest it's all about skew. How do you actually bring a positive skew mindset
into your research?
I think one of the most important ways to bring positive skew into our investment process is to have a strict discipline around that from the very beginning. All of the ideas that we vet all the way through the final research imposes a strict discipline around having a positive skew mindset and avoiding unintended bets that can lead to negative skew outcomes. A second huge area for us is to think about how we can normalize a return stream, to be aware of the skew risk that might be inherent within it. And that actually, when we test many of the signals that we are vetting, excludes a huge number of very standard signals that exist in the hedge fund industry and leads us not to invest in them, but to focus on signals that have a more favorable return to skew profile rather than return to risk profile or Sharpe ratio. One of the other areas that we're focused on very intently right now is thinking about how to apply machine learning and optimization to our signals in order to improve their return profile, but to do so in a way that does not accentuate the potential for left skew events. Many ML algorithms and optimization approaches have that as an unintended side effect, and it's something that we're very focused on not incorporating as a part of our research.